Ladies and gentlemen, welcome back to the channel. You are seeing a dump here in after hours for the NASDAQ, the S&P, basically all of your big tech stocks out there, your stocks that did poorly today. The NASDAQ was down about 2.5%, specifically the QQQ, which tracks the NASDAQ 100. Here in after hours, things are accelerating. You are down 0.65% in after hours, following Meta's results, which initially caused the stock to rally. Some comments during the earnings call, while causing the stock to fall a little bit here in after hours. Google is down another 1.5% here in after hours. Microsoft, the leader today, down 1%. Tesla, one of the better stocks today in the land of big tech stocks, down 1.3% today. And Apple, down over 0.5% here in after hours. What in the world is going on? What do you need to know heading into tomorrow? Tomorrow is going to be an epic day for our markets. And I think that is safe to say right now. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comments section. Let's go ahead and get straight into it. So number one, what is affecting the broader indexes here in after hours is definitely Meta's earnings call. Meta is now down about 2.6%, and it's also not helping that the other names are down that we just mentioned, especially a Microsoft. Microsoft ended up today about 3%. It was the bright spot. If Microsoft was down, call it 1-2% like these other names were today, you would have had an over 3% down day for the NASDAQ. And it's one of those situations that kind of usually happens out there. A stock reports good earnings, it goes up the day after earnings, it gives some of that back the next day. So that give back is happening here in after hours. But tomorrow, you have a massive catalyst. And this catalyst, I think the markets already know how it's going to go. Yeah, I think that's part of what we're seeing here in after hours as well. The sell-off getting worse right now as we speak. Your big catalyst coming tomorrow morning, two of them. Durable goods orders month over month. Holy moly, you're expecting 1.7%. Last month's reading was 0.2%. You're expecting a sharp acceleration, a 1,500% acceleration from last month's number. That's a lot, okay? That's showing the economy is way too hot, way too strong. But it gets better than that, because your GDP growth rate, quarter over quarter, advanced data for Q3, you are expecting 4.3%. 4.3%. That's actually insane. Like, actually insane. Now, with the GDP report, a couple things you guys need to know. If you come in at 4.3% or higher than that, the markets are going to say the Fed is going to raise rates again. Rates need to go higher. That is, I would say, the big story of the day today. Besides, obviously, Google down. I mean, if you include after hours, now you're down, what? Almost 12%. Pretty rough day for Google. Google McDougal. Pretty rough day. But you also seen bonds go insane. So this is a chart of TLT, the 20-year Treasury ETF. It's the easiest way to track the price of bonds. This chart has been going down for a long time now. Look at this. A multi-year, ever since the Rona, basically. You've been going down on this chart. When this chart goes down, investors are selling the bonds. That means yields are rising. So yields have been rising dramatically recently. And today, you are down 2.23%, and you are down 0.37% here in after hours. So on top of Meta, now down 2.5%, dragging all these other names down. You also have the bond yields, which today were shooting higher, and here in after hours are shooting higher. If you take a look at the 30-year Treasury, 30-year treasuries were up almost 15 basis points today. 10-year treasury yields were up about 11 basis points today, almost 12 basis points. You are on the 10-year treasury at 4.961%. That's getting up there again. That's getting up there to almost that 5% critical threshold level. Now, tomorrow, if your GDP report, again, comes in at 4%, even in the threes, well, that's a sign, at least you would think, that yields probably need to go higher. The Fed might need to raise rates again. The economy is too hot. That's not exactly the best position to be in, right? You could get runaway yields here, and that's not what the markets want to see. On the other hand, geez, and the selling is just getting worse like every second. On the other hand, if GDP were to come in way lower than expectations, you would probably get some form of a bullish market if you got a GDP report in the ones or even the low twos. The markets are going to say, hey, maybe we're slowing down here. The Fed's definitely not going to raise rates because we're slowing down compared to last month's number, but it would still be high. Now, if it's too low, then the fear is, well, crap, we're probably going into a recession. So let's be honest here. If you guys want my honest opinion, there's probably no good outcome for tomorrow morning. Question is, do we have another huge down day like we did today? Or is it a more mild down day tomorrow? Now, what if GDP comes in way higher than expectations, which is not too unnatural or out of the realm of normal for 2023. We've seen some crazy strong economic data that nobody thought was going to happen. What if we got like a 6% GDP report? Yeah, we have a problem on our hands. Big problem. Because that means we might price out completely any of the rate cuts in 2024. That means investors are probably going to sell the bonds off even more, drive rates even higher, and then at that point, you're definitely getting some runaway 10-year treasury yields. And at that point, investors start to say, hey, the higher these yields go, the more likely something is going to break, right? If 10-year treasury yields go to 7, 8, 9, 10%, I mean, at that point, it doesn't even make any sense to own a stock. But at that point, you're probably going into a recession regardless, and probably a deep one at that. So that's a big concern that I think markets have right now. Now, given this drop that we're seeing here in after hours, just everything taking a beating. I mean, Google's down another 2% here in after hours. And Google had pretty good earnings. Like, Google's earnings were not a disaster by any means. They were actually pretty dang good. Somebody might already know what that GDP report is going to come in as. And if I were to speculate, it's probably going to come in higher than expectations based on this move we're seeing here in after hours. Now, a couple other things the markets are reacting to, one of which would be this news. Israeli Prime Minister Benjamin Netanyahu has announced that the date for the ground invasion of the Gaza Strip has been set. So they have already made up their minds. They're already going into the Gaza Strip. Again, question is really at that point, what kind of retaliation do you see from other countries? There's some not so friendly words being exchanged with Turkey, obviously Iran, Syria. We're getting attacked, the U.S., at their military bases in Iraq. It's not a great situation. The odds of escalation from here are not great. And we're probably going to experience a crash here in the markets. I wish I didn't have to say this, but the way things are going, the selling could get a whole lot worse before it gets better. And if this situation with Israel does spill over into a larger regional war, that could make the crash much worse. Like I've said before, guys, 10, 15, 20, 30, 40% is really what you're looking at here if this conflict were to really spread into a much larger regional conflict. And if you're looking at the NASDAQ here, I mean, you're roughly right there. 12% down from here is going to put you at about 307. 20% is going to put you at about 279. It's definitely not out the realm of possible here. Okay, and then to get back to the lows that you were at October of this time last year, that would be about 28%. So somewhere around there could happen. And I don't think a lot of people are positioned for that. Now, something else happened today that is not exactly great news, especially this move down in after hours really confirms it. You have fallen quite a bit now under this downtrending line of support. And this was really your last support level before you potentially fill the gap. The gap to fill is going to be down here at about 320 on the QQQ if you want to fully fill the gap. You could say you're kind of halfway filling the gap down here at 337 where this 200-day moving average is, and I'm sure you would find some support around there at least for a brief, little while. But yeah, a close under this line, I've talked about it before, but that could potentially even send you back down to where you are at in 2022, right? Before this August rally, down here in the 300, 290 range on the NASDAQ, this is not going to be great. Now, today you did have oil that went up about 2%. That is also not great. The dollar, let's go ahead and refresh this so we have the most up-to-date info. The dollar was up about 0.25%. Not terrible, but not great. You definitely don't want to see the dollar up. Gold was up here in after hours, including the after hours move, about 0.5%, which we live in a very strange time where gold and treasuries are really your two assets that people consider like risk-free, that are that flight to safety or flight to quality, flight to safety, whatever you want to call it. More so a flight to safety. And when gold is up, you should see treasuries up. If treasuries are selling off and gold is up, that means there's still a flight to safety. There's still fear out there, but investors just don't want to own the bonds. This is obviously accomplishing what the Fed wants to accomplish, even potentially putting too much pressure on the economy, could even cause the Fed to U-turn and cut rates. Let's be honest, inflation has been defeated. And I know a lot of people say, well, everything's so expensive. Yeah, everything's so expensive because you've already seen inflation. You're not continuing to see inflation. It is dramatically slowed down compared to where it was prior. Prices are just high. So putting this much extra strain on the economy, heading into an uncertain time with a potential regional war, you actually could see rate cuts, maybe emergency rate cuts, a lot sooner than you might expect. Now, again, that really depends on this whole conflict situation. Because if you get 6% GDP, you're probably not going to get emergency rate cuts. But if you do get runaway treasury yields, that can be a problem. Because think about it like this. Right? If a stock pays you a 10% dividend, well, anything over like 4.5%, 5%, I'm sketched out. Because I'm like, why? Why is it paying 10%? Because investors don't want to own this stock. If they wanted to own the stock, they would buy the stock, drive the stock price up, you would get paid a lower dividend. So why in the world do people not want to own the bonds? Well, you could make a very valid argument that without the Fed buying bonds and no sign of rate cuts coming anytime soon, with, strong economic data, that you start to look at the fundamentals of the government at that point. You start to say, hey, Is the government in a better or worse spot today than it was in the past? Is it more likely to default today or what we've seen in the past? And the clear answer is today. We went close to a default just a couple of months ago. So the higher the risk, the higher the yield. And the risk is definitely a lot higher than we've ever seen before. So the yield should be higher as well. And that's where you get into, again, that runaway bond yield situation. And maybe the only thing that could stop it is the Fed actually cutting rates. That might be the only thing that could stop the selling of bonds. Who knows? I mean, Bill Ackman just said he covered his bond position or his bond short, and bonds are right back down to the same point they were at when he said he covered his bond short. It's just not a great situation to be in. Okay, the whole thing's not great. Now, AMC stock, if you are an AMC stock investor, which I'm sure most of you guys probably are, was down about 0.5% today. Really strong day. A really strong day. Considering the NASDAQ was down 2.5%, AMC down 0.5%, I will take that any day you want to give it to me. Okay, what this really tells me is AMC is probably not going to fall nearly as much as the broader markets. If we do get a 15% pullback from here, which I do think is probably likely at this point, let's just be honest, probably going to get another 10 to 15% pullback from here. You've fallen about 10% from the highs. Another 10% would technically put you believe into a new bear market. Another 10% from here would put the NASDAQ down to about 315. I really don't think that is too unlikely right now, and probably probable. Now, if you do get that 15, possibly 15% downside from here, AMC stock probably falls to about $8 per share. In line with this downtrending line of support. And then you're probably going to find that bottom. You're probably going to base out right about there. I don't think you're falling back to $7 per share, $6, $5 per share. Anything's possible. Again, when you're in times of fear and uncertainty, anything can happen. You can overshoot any downside move. That's always going to be a possibility. But what AMC did today really should stick out to you, as you're probably going to get a lot of strength with AMC. So there you have that. If you look at the technicals, the RSI is at 43.08. The MACD is wants to go positive. It really does. It's negative 0.77 on the MACD line. On the signal line, negative 1.15. So pretty dang close to going positive here on the MACD. That's exactly what you want to see. Once you do get that positive break, probably going to be a bigger move than not to the upside. If you take a look over here at the option activity for AMC stock, about 17,000 worth of options placed today. It was one trade, a November 3rd $10 call, which is still, out the money. They bought these for $33, so break even of $10.33. That would be about $1 move higher from here. So that's a pretty dang bullish bet by the end of next week. So someone thinks AMC stock is going higher from here. If you look at the Ortex data, you have a short score of 56, $120.06 million worth of short positions. Estimated short interest of free float at 6.51%. Free float out on loan at 7.79%. Shares out on loan 15.4 million. Days to cover 0.8. Cost to borrow 1.27. And utilization of 35.8%. So nothing is too exciting, too crazy over here. Cost to borrow fees about 1% across the board. Again, you got to take this data with a big grain of salt because it says the short interest of free float is 6.45%. And we know that is obviously not true. So who knows where they're pulling these numbers from, but they're definitely not correct, guys. So that's really what you have in store as of right now. Again, I just want to be very clear with this Middle East conflict. The invasion itself might actually be bullish for the markets. Why? Because there's been a lot of uncertainty around if it's going to happen, when it's going to happen. It looks like it's definitely going to happen. When it does happen, if you don't see an immediate retaliation from an Iran or Hezbollah, then that might actually be a bullish event for the markets. I would expect it to be a bullish event for the markets. But when you do get involvement from one of those other entities, it probably turns into a pretty bad situation quickly. And, you know, when it's like opposites, right? So I believe right now it's like midnight over there, maybe like 2 o'clock in the morning, something like that. So when it's daytime over here, it's nighttime over there, or pretty close to, or by the time stocks stop trading, it's basically nighttime over there. Once you open for trading, it's, you know, basically light out, right? So you're not going to have or getting dark once you kind of open for trading kind of midday. So you're not going to have much of a chance to trade this if it happens early morning, in which I would expect any kind of invasion to happen early morning. You kind of have to just hold your hedges right now and just wait and see what happens. Because again, when you get that news that the invasion has started, the incursion into Gaza has started, you're probably not going to have a chance to trade it. Markets are probably not going to be open when that news does come out, guys. So there is that. If you guys would like to come trade with me live in real time, come get access to all of the trades that we make. We had a trade today on ServiceNow. That one did not pay off. I'm very shocked, actually. But that was just like $100 YOLO. So not a crazy big deal there. I'm actually super shocked. The stock's up 5% here in after hours off really not too stellar earnings. So might need to look into that a little bit more. It is somewhat illiquid. But nonetheless, guys, if you guys want to come trade with us live in real time, link down below in the description of this video. The last thing that I do want to point out is the earnings calendar for tomorrow. You still got some big earnings. By far, the biggest one is going to be Amazon, Enphase, Intel, Ford, Chipotle. That's pretty much it for your big ones. Tomorrow morning, UPS is going to be the big one. Southwest can be important, just give you a gauge of the consumer and travel demand. But UPS is really the big one for tomorrow morning. You want to see is UPS doing good? If UPS is doing good, holiday season's probably going to be pretty good. If they're not, well, that could be a problem for markets. Same thing for Amazon. Tomorrow is definitely a consumer-based bunch of earnings reports, if that makes sense. So hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.